Welcome to Tech Money Madness, your daily U.S. stock market podcast, June 22, 2026.
Yeah, and if you are checking your portfolio hoping for a quiet day,
Right.
you might want to brace yourself.
Seriously, I mean, imagine raising billions of dollars in a historic, record-breaking IPO, only to watch, 16% of your company's value just completely evaporate in 3 days?
Right, like SpaceX is finding out that gravity actually applies to everyone, even the absolute darlings of Silicon Valley.
Exactly. So welcome to today's deep dive. We are looking at a really comprehensive daily market briefing for today, and it is a rough one. We are looking at a profound systemic contraction here.
Yeah, both the S&P 500 and the Nasdaq closed significantly lower today. It really is a staggering pullback.
It is.
And what stands out to me is the gravitational pull of it all. We aren't just looking at a few obscure, highly leveraged companies struggling. The major indices are being actively dragged down by the heaviest hitters in the room.
The megacap tech stocks.
Exactly. Mega cap tech. Alphabet specifically is really pulling the floor out from under the broader market today.
Right. Now, before we jump into the mechanics of why this is happening, I want to point out something kind of unique about our source material today. We actually don't have the standard list of top gainers, top losers, or, those minute-by-minute trading volumes.
Which is actually refreshing.
Totally. Honestly, I think that is an incredible advantage for us and for you listening. When we strip away the distraction of just chasing individual ticker symbols.
Like agonizing over every microscopic daily shift.
Yeah, exactly. We are forced to look at the structural themes that are actually driving this chaos. So our mission today is to look right past that surface level panic.
Right.
We need to connect the dots between some severe global macro shocks, a very real reckoning in the tech sector, and a quiet but massive power shift happening in the everyday physical economy.
Because without the noise of that daily leaderboard, we can actually examine the engine underneath the market. And right now, that engine is under an immense amount of pressure.
Oh, warning lights flashing all over the dashboard.
Exactly.
So before we even look at a single stock chart, we have to talk about the atmospheric pressure in the room. We need to start with the overarching global and economic environment that is dictating the cost of doing business today.
Yeah, the macro stuff.
Right. And it starts with the end of an era. Former Federal Reserve Chairman Alan Greenspan has passed away at the age of 100.
It is truly the end of a very specific chapter in economic history.
Yeah.
For you listening who might not follow central banking history super closely, Greenspan was... Well, he was synonymous with navigating historical market turbulence.
He was the guy.
Right, the chief architect of U.S. monetary policy, meaning he controlled the levers of money supply and interest rates through crises that really entirely defined modern finance.
And there is this deeply poetic, almost unsettling timing to his passing today.
Absolutely.
Because we are dealing with the exact same flavor of global uncertainty that he used to manage. Look at the current Federal Reserve. Today, they are holding interest rates steady.
Right.
But, and this is the critical part, they're actively signaling a bias toward potential rate increases.
Which changes everything.
Right. And when we say the Fed raises rates, what they are really doing is making it more expensive for companies and everyday people to borrow money.
Yeah, it's a tool used to intentionally slow the economy down and fight inflation.
Exactly. And they are warning the market about this while the geopolitical map is, highly volatile.
The complexity of that volatility is the real key here.
Which brings us to the Middle East. The government of Iran has just declared the Strait of Hormuz closed again.
Wow.
Yeah. And for context, that is a critical geographic choke point for global shipping and oil supply. And yet, at the exact same time, the U.S. Treasury Department has just authorized Iranian oil sales through August.
Yes, the juxtaposition there is just striking.
Okay, let's unpack this. Because to you and me, that sounds like a fundamental contradiction.
Oh, totally.
Think about it like driving a car, right? Is the Fed driving with one foot hovering right over the brake pedal, meaning these potential rate increases, while this situation in Iran threatens to throw a slick patch of oil onto the road ahead?
That's a great way to look at it.
Like, how do we reconcile the Treasury authorizing oil sales while the physical strait where that oil ships is being actively blockaded?
What's fascinating here is the severe tension between financial policy and physical reality.
Right.
On paper, the U.S. Treasury is easing a financial sanction. They're saying, yes, the transaction of Iranian oil through August is legally authorized.
Turning the financial faucet on.
Exactly. Likely to try and stabilize global oil prices by injecting supply into the market. But physically, geopolitically, Iran is closing the strait.
Wow.
So you have a situation where A sale might be authorized in a spreadsheet in Washington, but the physical commodity literally cannot move through the geographical choke point.
It's like having a confirmed paid ticket for a flight, but the airport runway has been destroyed. Like the transaction cleared, but the plane can't take off.
Precisely. And if we connect this directly back to the Federal Reserve, this is exactly why their foot is hovering over that brake pedal.
Because of the inflation risks.
Right. This specific type of geopolitical supply chain disruption is the textbook definition of an inflationary catalyst. Let's trace the mechanism, right?
Okay.
If oil can't get through the Strait of Hormuz, global energy prices spike. If energy prices spike, it costs more to manufacture and ship literally every good on the planet.
And if everything costs more, inflation surges.
Exactly. The Fed is maintaining a bias toward rate hikes because they are watching this geopolitical bottleneck in real time. They are preparing to make borrowing more expensive to combat that inevitable inflationary fallout.
And here's where we bridge the gap to what's happening on Wall Street today. Because, you might be wondering, why does a software company in Silicon Valley care if the Fed raises interest rates due to oil prices in the Middle East?
It's all about the cost of capital.
Exactly. Tech companies, especially the ones pushing boundaries, they rely on borrowing cheap money to fund years of research before they turn a profit.
Right.
When borrowing gets expensive, investors stop funding long-shot dreams. They demand immediate, flawless execution. Which brings us to the epicenter of today's market drop. Let's talk about the megacap tech tremors.
Yeah, for a long time, the market treated megacap tech as this invincible safe haven.
Right, like they could do no wrong.
The prevailing narrative was that their algorithms, their software dominance, and their massive cash reserves just insulated them from physical supply chain problems. But today's briefing really shatters that illusion.
Totally shatters it.
The threat of expensive capital, compounded by very real internal company struggles, is aggressively pulling down the market's heaviest hitters.
Let's look at the damage. Alphabet just suffered its worst day in over a year.
Yeah.
The briefing points to two specific culprits here: mounting concerns over artificial intelligence and high-profile employee exits.
Which is huge.
It is. And then you look out into the broader growth and innovation sector, and SpaceX, which, like we mentioned, just had this historic IPO, their stock just tanked 16%.
Just a brutal run.
That extends a pronounced three-day slump for them. But I want to challenge this narrative for a second.
Okay.
Are they really losing their safe haven status, or is this just a natural, healthy correction? I mean, a 16% drop is alarming, but SpaceX still virtually owns the commercial satellite market. Are investors just taking profits after an overhyped IPO?
It is a fair pushback, and some of that drop is undoubtedly standard post-IPO volatility.
Right.
However, a 16% drop in 3 days signals something deeper than routine profit-taking. It signals a shift in risk appetite.
How so?
Well, when the cost of capital is virtually zero, investors will tolerate delays. They'll accept shifting timelines for a company building rockets or, massive AI models.
Because the money is cheap.
Exactly. But with the Fed signaling rate hikes, that grace period evaporates. Investors are looking at these sky-high valuations and demanding tangible near-term returns.
That makes sense. The runway is just getting shorter.
Significantly shorter.
And speaking of demanding returns, over at Meta, there is a major leadership shakeup happening today. The head of WhatsApp is stepping down, and they are bringing in Kunal Shah, an Indian fintech founder, to replace him.
Yes, the Meta move is highly indicative of the structural shifts we are seeing across the board.
Here's where it gets really interesting. Because looking at Meta, bringing a financial technology guy into a messaging app feels like a glaring signal that their traditional advertising model has hit a wall.
Oh, absolutely.
WhatsApp has end-to-end encryption, so they can't easily mine your conversations for targeted ads the way they do on Facebook or Instagram. Are they panicking because they can't monetize their biggest user base, or is this a calculated evolution into a payment platform?
If we connect this to the bigger picture, it's absolutely a calculated evolution, but one born entirely out of necessity. You nailed the underlying mechanism there. WhatsApp has billions of users, but monetizing a secure messaging app is notoriously difficult. By bringing in a fintech founder, Meta is signaling a massive realignment.
A pivot.
Right. They're saying, we have the attention, now we need a financial expert to turn this into a transactional ecosystem, much like WeChat does in China.
Okay, I see.
But I want to go back to your point about Alphabet's employee exits for a second, because it highlights something crucial.
Oh, yeah.
What is truly causing this tech volatility isn't just the software, it's the human capital.
Explain that dynamic. Why does the broader market care if a few senior engineers leave Google?
Because high-profile exits in the AI space aren't just empty desks. They represent a transfer of highly specialized intellectual property.
Ah,
AI development isn't like an assembly line. It requires incredibly niche expertise to optimize these large language models. When the architects of your AI infrastructure leave, they literally take the roadmap with them in their heads.
wow, right. So the market reacts to that brain drain.
The market immediately questions the viability of your future products. You cannot simply mandate innovation from the boardroom. You need the talent to actually execute it.
Which means the days of throwing money at a whiteboard and promising future growth are totally over. They need the talent and they need to show the math today.
Exactly.
And that leads us perfectly into the next layer of this tech contraction. Because if the software giants like Alphabet are struggling to lock down their AI strategy and their talent, what happens to the companies that are building the physical infrastructure for that AI?
This is where the structural cracks become visible in the hardware space. We are seeing a severe squeeze in semiconductors right now.
Right. According to the briefing, NVIDIA's stock is notably struggling today. And there is a very specific, fascinating detail here. Kalshi traders are actively predicting that NVIDIA's chip prices are coming down.
Yeah, that's a huge indicator.
Now, for you listening, Kalshi is a prediction market where people put real money on the line regarding future events. So traders are betting actual cash that the cost of NVIDIA's highly coveted AI chips is about to drop.
Right.
Plus, we have high anticipation from Micron and Cerebras. They are both set to report earnings this week, and traders are expecting giant, volatile moves.
The anticipation around those earnings cannot be overstated, particularly regarding what we call margin compression.
Break down margin compression for us in this context. What does that actually look like?
Simply put, profit margin is the difference between what it costs to make a chip and what you can sell it for.
Okay.
For the last few years, demand for AI chips was so intense that hardware companies had absolute pricing power.
They could charge whatever they wanted.
Exactly, they could charge premium prices, resulting in massive profit margins. But margin compression happens when a company is forced to lower its prices to maintain sales volume, which of course shrinks their profit.
So if Kalshi traders are right and chip prices are falling, it means those historic profit margins are compressing.
Precisely.
So I have a pointed question for you based on that.
Go for it.
If Alphabet is the gold miner out in California struggling to find the right AI gold, is NVIDIA the shovel seller who suddenly realizes they have way too much inventory?
That's a great analogy.
Because if these prediction markets are right, does that signal just a temporary blip in the supply chain? Or are we looking at a systemic repricing of the entire AI infrastructure? Have the gold miners simply bought enough shovels for now?
This raises an important question, and it is the exact scenario keeping institutional investors awake at night right now.
I bet.
The dynamic you described is perfect. If chip prices are indeed dropping, it implies a fundamental shift in supply and demand.
Right.
It suggests that companies like Alphabet or Meta are realizing their current AI software isn't generating the immediate profits required to justify buying more chips at those premium prices.
So they just stop buying?
They pull back on their infrastructure spending.
Which sends a shockwave down the supply chain.
Exactly. This is why the upcoming earnings reports from Micron and Cerebras are so critical. This isn't just about how those two specific companies performed last quarter.
It's bigger than that.
Much bigger. Their earnings will serve as the ultimate litmus test for the entire AI hardware sector.
Wow.
If they signal that demand is softening or that their margins are compressing, it validates the prediction markets. It explains why the broader tech sector is experiencing such extreme volatility today.
Because the whole foundation is shaky.
Right. The foundational assumption that building AI hardware is basically a license to print infinite money is being aggressively stress-tested today.
It is a profound reality check. The software companies are losing their top engineers and struggling to monetize, and the hardware companies might be losing their pricing power. It is a perfect storm.
It really is.
But here's the thing. The global economy doesn't just halt because Silicon Valley is having an existential crisis.
Definitely not.
While the tech sector burns hot and volatile, if we shift our perspective, there are sweeping changes happening in the physical, everyday economy. Capital is like water. It flows away from resistance and seeks a new home.
That is the core principle of capital flow. Institutional money doesn't just evaporate during a tech sell-off.
Right.
It relocates to find stability.
So let's look at where that water is flowing in the physical world, starting with housing. The briefing notes that the U.S. Senate is poised to advance a bill aimed at limiting private equity purchases of single-family homes.
A major development.
Now, just looking at this impartially as a legislative market factor, we need to understand the mechanism here. Private equity refers to these massive Wall Street investment funds that pool billions of dollars.
Right.
Over the last few years, they've been buying up residential homes with cash, turning regular neighborhoods into corporate rental portfolios. The Senate advancing a bill to limit this is a massive intervention in how real estate capital operates.
It creates a hard, structural roadblock for institutional money in the housing market. If those billions of dollars can no longer be deployed into suburban real estate, those fund managers have to pivot.
Then you look at the automotive sector, which is showing extreme signs of consumer anxiety today. Lucid Motors is laying off 18% of its U.S. workforce.
18% is huge.
It is. And their chief operating officer, Mark Winterhoff, is leaving the company. So residential real estate has legislative hurdles, and autos are seeing executive flight and workforce reductions.
Right.
But then, right in the middle of this, you find a bright spot of heavy investment, healthcare logistics.
Which seems so random at first glance.
Right. UPS is pouring $48 million into temperature-controlled facilities.
That juxtaposition tells the entire story of today's market.
So what does this all mean? When I look at all of this together, it shows exactly how interconnected these sectors are.
It's all linked.
When capital gets squeezed out of megacap tech because of AI fears, and private equity faces legislative roadblocks in the housing market, the money has to find a path of least resistance.
It's basically capital whack-a-mole.
Exactly. It seeks tangible stability. And suddenly, pouring $48 million into commercial, temperature-controlled healthcare warehouses looks like a remarkably strategic, safe bet.
Let's tie the underlying mechanisms together here. The automotive breakdown we are seeing with Lucid, an 18% workforce reduction, reflects the direct impact of the Fed policy we discussed at the very beginning.
Interest rates.
Right. Consumers are worried about inflation, and they're facing higher interest rates on car loans. Naturally, they pull back on buying expensive electric vehicles. That sector contracts.
And the housing bill acts as a dam, blocking capital from flowing there.
Precisely. By stepping into the housing market, the government is effectively telling massive investment funds that residential real estate is no longer an unrestricted playground.
Right.
So digital tech is volatile, consumer autos are contracting, and residential housing is being legislatively capped.
Which leaves us with commercial logistics, the warehouses.
It leaves us with UPS investing heavily in specialized physical infrastructure. This is a crucial indicator of where smart capital is finding shelter right now.
Okay, that makes total sense.
While digital infrastructure, the AI chips and the software algorithms, is proving to be incredibly unpredictable, specialized physical infrastructure is attracting serious, stabilizing investment.
Because it's a sure thing.
Right. Healthcare logistics is fundamentally insulated from consumer discretionary pullbacks. Even in an economic downturn, people need medicine, and that medicine needs to be transported and stored safely.
So it's recession-proof, basically.
Exactly. Building temperature-controlled facilities is an unglamorous nuts-and-bolts investment. But in a chaotic market, unglamorous and predictable is exactly what investors crave. It represents a tangible asset with a guaranteed long-term use case.
It is the ultimate pivot from the virtual to the physical, which honestly brings us full circle on this entire deep dive today.
It really does.
Think about the incredible journey we just took through the underlying mechanics of today's market. We started with the passing of a central banking legend, Alan Greenspan, reminding us that navigating economic turbulence is just a historical constant.
Yeah.
We looked at the geopolitical powder keg in the Strait of Hormuz, mapping out exactly how blocked oil shipments drive inflation and force the Federal Reserve to threaten higher interest rates.
A true cascade effect of modern global economics.
Then we watch how the threat of those higher rates basically shattered the invincible armor of megacap tech.
Right.
We saw Alphabet bleeding specialized talent, SpaceX getting a pronounced post-IPO reality check from investors demanding immediate execution, and Meta desperately pivoting its leadership to finally squeeze actual revenue out of WhatsApp.
A huge reality check.
And we broke down the potential top of the mountain for AI hardware, explaining how prediction markets are betting on margin compression for NVDA, which turns the upcoming Micron and Cerebra's earnings into the ultimate industry stress test.
A stress test that will define the hardware narrative for the foreseeable future, frankly.
Absolutely. And finally, we tracked the flight of capital away from that chaos. Away from consumer auto layoffs at Lucid, away from legislative roadblocks in single-family housing, and straight into the cold, reliable concrete of UPS healthcare warehouses.
It's fascinating to watch.
It is a phenomenal reminder that the market is a living, breathing ecosystem where every action forces a reaction somewhere else.
The overarching lesson today is that everything is profoundly connected.
Yeah.
Geopolitical shocks dictate supply chains, which dictate inflation, which forces the Fed's hand on the cost of capital, which reprices speculative tech, which ultimately pushes investment back into reliable physical infrastructure.
So as we wrap up, I want to leave you with a final lingering question based on everything we unpacked today.
Okay.
We've seen how the capital flows away from resistance. If the AI chip market is indeed facing a systemic price squeeze, and if private equity is locked out of the single-family housing market by the Senate, where does all that sideline capital go next?
That is the million-dollar question.
Right. Will unglamorous physical infrastructure plays like UPS's temperature-controlled facilities, or maybe power grid upgrades or water treatment plants, quietly become the new safe havens in a deeply uncertain global economy? Are we about to witness the greatest minds in finance stop betting on digital moonshots and start betting on cold storage logistics?
It is a question that challenges the entire growth at all costs investment thesis of the last decade.
It really does. Thank you so much for joining us on this deep dive. Remember, when the market looks like a sea of red, don't just look at the surface level damage. Keep questioning the headlines, look for the hidden mechanisms beneath the surface, and always pay attention to where the water is flowing.
Well said.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.